Hello, this is Senior Hannington back in this session 2 for IFRS 16 leases. Remember, in the previous session, we looked at the introduction part of IFRS 16 leases. We looked at what a lease is, what are the parties to a leasing arrangement, and then how would we determine if the contract contains a lease. That was the first session. Now in this session, we are going to look at lessee accounting. Remember, in a leasing arrangement, we have two parties, that is the lessee as well as the lessor. Now we are going to look at lessee accounting in accordance to IFRS 16 leases, our new leasing standard. Now to take you back in the old standard, IAS 17 leases, in the books of the lessee, you had to first classify whether the lease is a finance or an operating lease. That was IFRS 16 leases. That was IAS 17 leases. However, in IFRS 16, in the books of the lessee accounting, there is no classifying the lease as a finance or an operating lease. So under lessee accounting, IFRS 16 completely abolishes the classification of a lease as a finance or an operating lease. As long as the contract contains a lease, then the lessee is required to recognize what we call the right of use asset and the lease liability. Now, according to our agenda today, lessee accounting, recognition and measurement at a glance. We are going to look at the initial recognition and initial measurement. Now, under IFRS 16, leases, lessee accounting, initially the lessee is required to recognize the right of use asset and recognize the lease liability. These two are initially measured at the present value of the lease payments. That is initial recognition and measurement. So meaning that the moment we see that there is a right of control of the identified asset, then we have to recognize the right of use asset and then the lease liability. Initially measured at the present value of the lease payments. That is initial recognition. Now, what about subsequent measurement? What about subsequent measurement? Now, when it comes to subsequent measurement, we have to see how we deal with the right of use asset after initial recognition and how we deal with the lease liability after initial recognition. You can see that for subsequent measurement of the lease liability, let us start with the lease liability. How do we subsequently measure the lease liability? Remember, initially we recognize the lease liability and measure it at the present value of the lease payment. Now subsequently we accrete the lease liability based on the effective interest method using a discount rate at the inception of the lease. So subsequently this lease liability is increased by the finance cost, which is computed using the interest rate impressed in the lease. Subsequently, the lease liability is also reduced by the lease payments made by the lessee. So we subsequently use the actuarial method when accounting for the lease liability. Now, under the actuarial method, you increase the liability by the finance cost. You also reduce the liability by the lease payments made by the lessee. So reduce the lease liability by payments made by the lessee. That is subsequent measurement of the lease liability. Now, what about the right of use asset? As I have told you before, that initially we recognize the right of use asset, and it is initially measured at the present value of the lease payments. Now, what about subsequent measurement? Now, according to IFRS 16 leases, the right of use asset has to be depreciated. We have to depreciate the right of use asset. Now, how do we depreciate the right of use asset? According to IFRS 16. Now, in fact, under IFRS 16, the same rule in the old standard IS 17 still applies when it comes to depreciating the right of use asset. What was the rule? The rule is that you depreciate the right of use asset over the shorter of the lease term and the useful life of the asset. So you depreciate over the shorter. So look at your useful life of the right of use asset. Look at the lease term. Depreciate over the shorter. So we use IS 16 property, plant and equipment for subsequent measurement. Alternatively, you can use IAS 40 for subsequent measurement, depending on the purpose of the right of use asset. Because it can be a property, plant and equipment, or it can be an investment property to be accounted for in accordance to IS 40 investment property. That is subsequent measurement. Now, what do we report in the financial statements? Now, in the profit or loss, that is the statement of profit or loss. What do we present in the statement of profit or loss? Now, the moment the contract contains a lease, it means that you have to recognize the right of use asset as well as the lease liability. So your statement of profit or loss should show a depreciation charge of the right of use asset. At the same time, the statement of profit or loss should also show the finance cost on the lease liability. So meaning that in your profit or loss, always report the depreciation expense, then also report the finance cost. That is the interest expense on the lease liability. Now, we have to recognize the right of use asset as well as the lease liability. But now the question is, how do we initially measure the right of use asset and how do we initially measure the lease liability? Now, according to IFRS 16 leases, the initial measurement of the right of use asset equals to the initial amount of the lease liability, that is the present value of the lease payments. So initially measure at the present value of the lease payments. Then in addition to that, you have to add the lease payments made to the lessor at or before the commencement date. So you also have to add that. However, if there are some incentives received by the lessee, now these incentives have to be deducted. Then we have to add the initial direct costs. Talk about legal fees in case of any. These legal fees or the initial direct costs are supposed to be capitalized. In other words, you add them to the initial amount of the lease liability when coming up with the initial amount of the right of use asset. Then in addition to that, you also have to add the estimated cost of removing and or restoring the leased asset. You also have to add that when you're coming up with the initial measurement of the right of use asset. So initially record the amount of the lease liability, add the lease payments made to the lessor at or before the commencement date, then less the incentives received by the lessee, then plus the initial direct costs, then plus the initial estimate of the cost of removing or restoring the leased asset. That is how we initially measure the right of use asset according to IFRS 16. So you need to know how do you initially measure the right of use asset, because in exams, the examiner can try to bring in some of the costs. So some costs can be capitalized, others may be excluded. So you need to know what do we initially include when measuring the right of use asset. So you have to master how to initially measure the right of use asset. Let us also look at initially how would we measure the lease liability. Now the lease liability, remember initially it is measured at the present value of the lease payments. So we look at the future payments, but we discount them to get their present value. So those payments which have not yet been made at the date of the inception of the lease. So we have to capture the fixed future payments for the lease elements, the incentives receivable over the lease term, plus the variable payments linked to an index, then the exercise price of the purchase option. Remember, in the contract, there can be an option that maybe after the lease term, the lessee will purchase the asset. So that purchase price, we also have to include that when we are coming up with the initial measurement of the lease liability. Penalty for termination of the contract. Maybe over the lease term, you will find that there is a possibility of maybe the lessee terminating the contract. If there is that option of terminating the contract, there has to be a fee. So that fee should also be included in the initial measurement of the lease liability. So you have to master how to initially measure the right of use asset as well as the lease liability. Because in some scenarios, for example, in the previous paper 8, that was November 2019 financial reporting, there was a question about leases. But in that question, the examiner tried to include some initial direct costs which were paid by the lessee. So meaning that they wanted to test if you know how to really measure the right of use asset as well as the right of use, as well as the lease liability. So you have to master how to initially measure the right of use asset as well as the lease liability, because that is a very key area. You can do all the calculations, but at the end you may find that you have wrong calculations because of initially coming up with the right of use asset as well as the lease liability. So take point of that always. Now, how do we present in the financial statements? We are going to see how do we present information about leases in the statement of financial position, in the statement of cash flows, as well as in the statement of profit or loss. Now, in the statement of financial position, you have to present the right of use asset under non-current assets. So you carry this asset at its cost, less accumulated depreciation and accumulated impairment losses. So you can either present the asset separated from other assets, or you can present it in the other assets. Okay? Don't forget that you can also make a disclosure note about the right of use asset. Now, still in the statement of financial position, we have to present our lease liability either by presenting it in the statement of financial position on its own, or we can include it in other liabilities in the statement of financial position, don't forget we can also disclose them separately in the notes to the statement of financial position. So either present the liabilities separately from other liabilities on the statement of financial position, or disclose separately in the notes. That is in the statement of financial position. What about in the statement of profit or loss? Remember, on the right of use asset, you have to calculate depreciation. So the statement of profit or loss should show that depreciation. Then when it comes to the lease liability, remember we have to use the actuarial method. So we have also to show the interest expense in the statement of profit or loss. Remember, these two expenses should be presented separately, don't forget. Now what about in the statement of cash flows? Remember, statement of cash flows, you present your cash flows in three main headings. That is cash flows from operating activities, investing activities, and financing activities. Now what do we present in the statement of cash flows in respect of leases? Now you have to present the cash payments for the principal portion of the lease liability within financing activities. Remember, the lessee is required to make payments at the end of each financial year. Now, part of the payment is for the principal payment or the principal portion of the lease liability, and then the other portion is for the interest expense. So your financing activities in the statement of cash flows should capture the cash payments for the principal portion of the lease liability. Now the interest expense portion is presented either within operating activities or financing activities, but I think for practical purposes it should be presented under operating activities. However, it can be a choice of the entity either to present them under financing activities or operating activities. But whichever is the case, you have to apply that consistently. So if we decide to present them under operating activities, then let that be the policy always. Now, what are the disclosures? What information should be disclosed in the financial statements about leases? Now, we need to know what are the disclosure objectives. Why do we need to disclose information about leases? Now, the main objective of making the disclosures is to enable the users of financial statements to assess the effect leases have on the financial position, performance, and cash flows of the business. So we need to know the effect leases have on the financial position, performance, and cash flows of the lessee, because we are looking at the lessee as the reporting entity. Now, what are the disclosures? The lessee is required to break down the lease expenses, that is depreciation and the interest expense, etc. So you have to show the breakdown of the lease expenses. The total lease cash outflows should also be disclosed in the notes of the financial statements. Talk about the additions of the right of use assets. Maybe during the year, the company or the lessee enters into some other leasing arrangements. So when we enter into other leasing arrangements and the arrangements contain a lease, then you expect there to be additional rights of use. So we have to disclose the additional rights of use asset, the books of the lessee. Talk about gains and losses from sale and leaseback transactions. Remember, there can be a sale and leaseback transaction. I sell the asset, at the same time I lease it back. Now, if that transaction involves a sale in accordance to Ifrs 15, revenue from contracts with customers, then you expect the lessee to recognize the asset, and then upon the recognition, there can be a profit or loss on the sale and lease back. Now, that profit or loss on the sale and lease back should also be disclosed in the notes of the financial statements. Talk about the carrying amount of the right of use assets by class of the underlying assets, etc. Now, those are the disclosures to be made by the lessee in the financial statements notes. Now you have to know that it's not just a matter of knowing the lessee accounting requirements under IFRS 16. Of course, you have to know the lessee accounting part of it, but remember the applicability. You have to know the standard contents and then how to apply them. So I'm going to use an examination scenario to see how we can apply the principles above. In other words, how we can apply the principles about lessee accounting under IFRS 16 leases. So exam alert. We have our exam alert, application of the principles above. Now, on 1st January 2015, this is our inception of the lease. Rebecca entered into a 5-year lease of machinery. So the lease term is 5 years. The machinery has a useful life of 6 years. So this is our useful life, 6 years. The annual lease payments are shillings 5,000 per annum, with the first payment made on 1st January 2015. Full stop. Now the payments are made on 1st January 2015. The first payments, meaning that in this scenario, payments are likely to be made at the start of each financial year. Remember, payments can be made in advance, that is at the start of the year, or payments can also be made at the end of each year, that is payments made in arrears. So you always have to look at the series of the payments. Are they made at the start or they are made at the end of the year? Information about payments is also very important. Now, to obtain the lease, Rebecca incurs initial direct costs. Rebecca incurs initial direct costs of shillings how much? 1,000. These are initial direct costs, shillings 1,000, which were incurred by Rebecca company. Remember, initial measurement of the right of use asset. That all those initial direct costs incurred before or at the date of commencement of the lease should be included in the initial measurement of the right of use asset. So these initial direct costs should be included in the right of use asset at the commencement date. In relation to the arrangement of the lease, but the lessor agrees to reimburse Rebecca shillings 500 towards the cost of the lease. Now there is an incentive to be received by Rebecca, our lessee. Remember, under the initial measurement of the right of use asset, these incentives should be deducted. So we have to exclude that shillings 500 in the initial measurement of the right of use asset. What next? The rate of interest in the lease is 5%. The present value of the minimum lease payments is shillings 22,730. Remember, initially the right of use asset is measured at the present value of the lease payments plus some other initial direct costs to be paid after or before the inception of the lease. But we have to less the incentives received. We also have to add the initial estimate of the restoring costs or the cost of removal of the leased asset. Then the lease liability is initially measured at the present value of the lease payments. Now, what are we required to do? Demonstrate how the lease liability will be accounted for in the financial statements for the end of 31st December 2015. Remember, the lease term is 5 years. The useful life of the asset is 60 years. We are going to demonstrate how the lease will be accounted for in the financial statements of Rebecca for the year ending 31st December 2015. Don't forget, there has to be initial recognition and measurement of the right of use asset and the lease liability. The right of use asset is initially measured at the present value of the lease payments, and that is 22,730. So initially, I will measure the right of use asset at that amount. Then I should also measure the lease liability at the same amount. So meaning that initially we are going to debit our right of use asset and credit the lease liability with the shillings 22,730. That is initial measurement and recognition. However, in the scenario we have seen that Rebecca incurs some initial direct costs of shillings 100, of shillings 1,000. Now those initial direct costs, remember, we have to capitalize them. So the journal entry is debit the right of use asset and the credit cash or bank of the lessee with the shillings 1,000. We have some incentives also, which we are received by Rebecca Company. Now these incentives received, don't forget that they reduce the right of use asset on initial measurement. So what do? We debit cash or bank of Rebecca, our lessee, then we credit the right of use asset with the shillings 500. Now this is senior's helping hand. Initial measurement and recognition, as I have told you, record the right of use asset and lease liability. You can see debit the right of use asset, shillings 22,730. Then equate lease liability with still the same amount. Then how do we record the initial direct costs? I've told you that capitalize them and then credit cash or bank for Rebecca, our lessee. Then the record of the incentives payments received. These incentives reduce the right of use asset, but cash or bank of Rebecca Company, our lessee, has to be increased by these incentives. So you debit your cash, shillings 500, then credit your right of use asset by the same amount. Meaning that on initial measurement, our right of use asset, we get the present value of the lease payments. That was 22,730. Add the initial direct cost of shillings 1,000, then minus shillings 500 for the incentives received. You can see that initially we are going to measure our right of use asset at shillings 23 to 30. That is our initial measurement of the right of use asset. What about subsequent measurement? The right of use asset has to be depreciated over the shorter of the lease term of the useful life of the asset. The lease term was 5 years. The useful life of the right of use asset is 6 years. So our shorter is the 5 years. So depreciate the right of use asset over a period of 5 years. That is subsequent measurement. So as you can see, depreciate the asset over the area of the lease term of 5 years. So get the right of use asset value, which is 23 to 30 over 5 years. You come up with a depreciation expense per annum of 4,646 for a period of 5 years. How do we analyze that? Debit your statement of profit or loss with that amount. Remember, that is an expense. Then credit accumulated depreciation. That is subsequent measurement for the right of use asset. What about for the lease liability? Remember, we have to use the effective interest rate method, or you can also call it the actuarial method. And in that method, you have to calculate the interest on the lease. So we're going to come up with our lease amortization schedule using the actuarial method. That is our schedule. So we need a column for years. That is our first column, as you can see. That is years. Remember, we are using 5 years. We have the second column that shows the opening balance. Then you also have the third column, which shows the annual payments. Then we have the capital balance. Then we have the finance costs, as you can see. Then you also have the closing balance, as you can still see. Now, this is the format of the table whenever payments are made in advance. That is at the start of the year. So get your year's opening balance. But because the payments are made at the start of the year, we first reduce the opening balance by those annual payments to come up with a capital outstanding balance. Then after coming up with your capital outstanding balance, then you can get your finance costs, meaning that I get my interest rate implicit in the lease, I subject it to the capital outstanding balance to come up with my finance cost. Then I get the closing balance. As you can see, that to get the capital outstanding balance, you get your opening balance, that is A, minus the annual payments. Then to get the finance cost, we are getting 5%, which is our interest rate implicit, times our capital outstanding balance. Then to get the closing balance, I get the capital outstanding balance plus the finance cost. That is my table. There is amortization table. Now, when you look at the table, this is our finance cost. So in the first year, Rebecca has to report that in the statement of profit or loss as an expense, the interest expense. Remember, we have to also present the lease liability in the statement of financial position. What is the lease liability in this case? Now, at the end of the first year, the lease liability is shillings 18,617. That is your lease liability at the end of the first year. But that lease liability can be split into non-current liability and current liability. Non-current liability and current liability. What is the non-current liability? The non-current liability is the capital outstanding balance of year 2, because the payments are always made at the start of the year. So our balance is 13,617. That is after removing 5,000 from the total liability at the end of the first year. So this is the total liability. This is your total liability, but the non-current portion of it is that. Meaning that if I want to get the current liability, get the total liability of 18,617 minus the non-current liability of 13,617. That difference is your current liability of the lease obligations. Now, how would we present our information in the financial statements? Remember, we have to present some information in the statement of profit or loss, that is depreciation and the interest expense. That is our extract of the statement of profit or loss for the year ended 31st December 2015. There is a finance cost from our table in the first year, that is 887. Then there is also our depreciation expense of 4,646. So your statement of profit or loss should always capture those two expenses when it comes to lessee accounting. What about the statement of financial position? The statement of financial position, we have to present the right of use asset under the non-current assets. As you can see, right of use asset at its cost. We have to less the accumulated depreciation as well. Then we come up with our carrying amount. This time there was no impairment losses, but if impairment losses were there, then we also deduct the impairment loss, but we don't have any. So what we have to do is to carry our right of use asset at its cost less accumulated depreciation to come up with what we call the carrying amount. Then we have to also present the lease liability. We have our lease liability at the end of the first year, which was 18,617. But don't forget, we have to split this into the non-current portion and current portion. As you can see, I told you that the non-current lease liability is the capital outstanding of the second year, and that is 13,617. Then the current liability of the lease obligation, that is the total lease liability at the end of the first year, which is 18,617 minus the non-current liability. The balance is 5,000, which is your current liability. So that's how we present the information about leases in the books of the lessee. That is in the statement of profit or loss and in the statement of financial position. Then what else? Yeah. Now there is a point to note. Remember, as I have told you, that at times payments can be made in advance or in arrears. Now, if payments were made in arrears, that is at the end of each year, then this will be the table, the format of your table. So start with years, get your opening balance, then you get the finance cost. Meaning that in this case, to get the finance cost, I get my interest rate increased, I subject it to the opening balance to come up with the finance cost. Then we less the annual payments, then we come up with our closing balance. Meaning that to get the closing balance, you get the opening balance plus the finance costs, then less the annual payments. That is the format of the table if payments are made in arrears. Never forget that, because they can either be in advance or in arrears, so you have to take point of the format of the tables. So that was all about lessee accounting. Visit my blog account and follow me. That is huntingtonsurrender.blogspot.com for more about IFRS 16 leases and for many more articles for financial reporting and advanced financial reporting students. Bye and thanks for watching.